Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. Today is November 18th, so we are just about 2 weeks out from the election, and it's been very interesting to see how the markets have reacted to the election and what people are saying they want to do, to the reaction to those that the incoming administration is trying to get into the cabinet position. So it's been very interesting to watch so far what's going on. What I wanted to look at today is I came across a chart this morning that I think is very interesting. Over the last year or so, we've talked a lot about interest rates. We've talked a lot about why interest rates have gone up, why they've gone down. We've talked a lot about inflation, how that's affected people. And what I wanted to concentrate on today is this graph that shows where the economy actually is right now versus what the Fed anticipated, or where the Fed anticipated that we would be at the same time. The reason I think this is important is because depending on what happens with this data will really determine what happens with the Fed and interest rates going forward. Obviously, we had an interest rate decline. We had a rate cut here a month or so ago, and it's going to be very interesting to see what happens to the Fed going forward. But a couple of things I wanted to share with you this morning that will affect what the Fed does, and obviously that will affect us long term. So there's 4 bits of data here that I wanted to go over real quickly and talk maybe a little bit about each of these. So the left side of the graph, or the lines, are the actual data points or the numbers as they've come back, tracking unemployment, core PCE. I'll explain that in a minute. The Fed fund rate, and then also GDP, our gross domestic product. So that's what the graph is. And then on the right hand side, the dots are what was projected by the Fed. So let's talk about kind of the differences here and why these make a difference. So the first one is the unemployment rate. That's the light blue line. And you can see it started out the year just above 3.5%. That has gone down to about 4.1. The Fed was anticipating that would be at about 4.4. So that's actually done better than was anticipated by the Fed. However, depending on what happens with immigration and possibly sending people back to the countries that they came from, that could push up push up unemployment a little bit, and that could affect wages, wage increases. There's a number of different things that could happen with that. So we're going to watch that very carefully. But as of right now, we're sitting at about 4.1% unemployment. The next is the core PCE. PCE is the Personal Consumption Index. The Personal Consumption Index is a measure of inflation. What does it cost to stay in the world that you're in, buying groceries and gas and housing, all those things combined? That gives a pretty good indication of what's going on with inflation. And as you look at the dark blue line, we started out the year, going back to June of 23, we started out at just below 4.5%. That is now down to about 2.7. The Fed was anticipating 2.6, so it's awfully close. So as of right now, the measures that they've taken have got inflation under control. But we're again on this teeter-totter where if they do too much in one area, then it could cause inflation to increase. So they're really kind of watching any kind of more Fed decreases, and don't want to go too fast and push inflation up again. The next one is the Fed funds rates. The Fed fund rate is the amount that banks loan to each other, or that banks can go to the Fed and borrow money in the short term. That's right about where they thought, and you can see that rate's gone all over the board. It's been up over 5%. Right now it's sitting at about 4.4, which is about where they expected it to be. The last one is our GDP, our gross domestic product. That has looked like it's been better, and then it's backed off and a little bit better. It looks like that they were anticipating about 2%. It's actually at 2.8. So it's better than anticipated. So what does all this mean? Why did I go through all this today? Well, that all has to do with how the economy is doing as a whole, and the economy is doing better than what most economists anticipated for year end 2024. So the reason I bring that up is the Fed watches these numbers as well, and they're watching this. And again, it's a fine balance between interest rates and inflation. So as of right now, inflation is down to just about where they wanted it, but there are some other indicators where the economy is maybe going a little bit better than what they had anticipated, which could signal more inflation. So what we're really going to watch going forward is, are we going to have any more rate cuts? Our feeling is yes, but our feeling is that we probably won't get as many as we thought. They won't be as deep as we thought. And so this next year, where we thought there could be as much as 1.5 to almost 2% decrease in interest rates, we don't think that's going to be the case, or at least not as much as of right now. The other thing is we're going to watch these, and so are the Fed. And if the Fed sees that inflation is creeping back, then we may not have any more rate cuts. So as of right now, it's really kind of touch and go, and it's going to be very interesting to see how the markets continue to react to a new administration and what they make a priority. A couple of things I also wanted to share with you. As of right now, interest rates, I looked this morning at what average 30-year mortgages are. And right now, average countrywide, and we're usually a little bit better than this, but the average 30-year mortgage today is at about 6.75%. Now, it was down to about 6, so interest rates have actually gone up just a little bit over the last month or two. But I wanted to give you some historical perspective on that 6.75%. As of right now, we are seeing fewer home sales or fewer houses changing hands than we've seen since about 1995. So there's a lot of people that are kind of waiting to see what happens with interest rates before they pull the trigger and either sell a home or buy a home, or both. But let me give you a little bit of historical perspective on this. I went back and looked from 1980 going forward what interest rates have been. In 1980, the average 30-year fixed mortgage was 13.74%. 1990, 10.13. 2000, 8.05. 2010, 4.69. And in 2020, 3.10. And again, today we're at 6.75. So historically, 6.75 is not out of the ordinary, and it doesn't seem like it's that high. However, when you go back 4 years ago, and it's more than doubled in just the last 4 years, it seems like mortgage rates or interest rates have gone so high that I think a lot of people are sitting on the sidelines waiting for it to go back. And we are going to watch that very carefully as well to see what happens with interest rates. Anyway, I hope this was helpful. I hope that's good information. Like always, we encourage your questions. Please either email us or call us if there's something you'd like us to go over. And we appreciate you joining us each week for these market updates. Thank you.